We haven't had a downdraft in the market for a couple of years. We've had back-to-back 25% gains. And to think that we can't have a 20 to 30 or 40% drop in the market, I think is naive. Now, I'm not just calling for that, but I'm just saying that you want to at least be positioned in companies that can weather that and have a little powder dry.
Welcome to Speak Up. I am your host, Anthony Scaramucci, on the Wealthion Network. I'm joined today by Jonathan Wellum. He's the CEO of Rocklinc Investment Partners, and he's a distinguished Canadian investment strategist. So I'm going to talk a little bit about Canada with him. And congratulations, by the way, on winning that hockey game last night. But in addition to that, he has been marked by a deep commitment to fundamental analysis and risk management, and these principles have become a cornerstone of a phenomenal business. And we are both talking to you from a remote location. Jonathan's a little bit less conspicuous than me because he's indoors. We're both down here in the Cayman Islands, so we have a love affair, at least with the tropics, you and I. But Jonathan, let's get right into it if you don't mind. Let's talk a little bit about where you see the market. Then I want to go into the geopolitical situation.
Yeah, I mean, from our perspective, as you know, Anthony, the markets are expensive overall, particularly the North American markets, the U.S. market. And there's a lot of geopolitical uncertainty. And so from our perspective, we're value investors. And what does that mean? We try to buy companies below their intrinsic value, and we try to hold them for 3 to 5 years. So we're not rapid fire, high turnover investors. And so when we look at the market, it's a lot of work. It's really hard to ferret out companies that are trading at attractive valuation, especially given political situation, along with the interest rate fluctuations over the last couple of years. So where we look at it, we're just very careful, keeping some cash around. We're about 75% invested, 25% in cash. And then we have about 25 main holdings that we have in terms of equities, where we're trying to find companies that have great long-term franchises and are well positioned despite the challenges that we're seeing in the market.
So, Jonathan, 25% in cash for me sounds like you think we're entering a bear market. So tell me why 25% in cash, or maybe I've got my risk management tools wrong. I don't know. The market goes up 75% of the time over the last 125 years. And I'm not saying we don't go through corrections, but that seems like a lot of cash. So give us the rationale.
Well, a couple of things. It depends on your clients. And so a lot of our clients are, older clients, and they don't necessarily want a lot of volatility. So some of the cash holding is really just to mitigate volatility for clients that don't want any major downdrafts in terms of their portfolio. So that's one issue. The second issue really is just overall price to earnings ratios, price to free cash flow. They're trading at very, very high valuations. And then the third thing would be geopolitical, just the uncertainty surrounding some of the adjustments that are taking place in the United States. We're not exactly sure what's going to happen there with tariffs. And when we look around the world outside of the U.S., where you've had really more robust capital markets, things are not that great in Europe. They're not that great in Japan. They're not that great in China. There's a lot of challenges. And so from our perspective, if we keep some powder dry, it doesn't necessarily mean we won't deploy it, but we're only going to deploy it when we can find companies trading at good discounts. And then we can move quickly. So if we do get a major downdraft in the market, then we can deploy, very rapidly. And, that's just the way we manage money. And we typically outperform the market over the long term, over a 3 to 5 year period, pretty consistently, and just get more juice out of the companies we are investing in, but keeping a little bit to the side. But as I say, part of that's just our clientele. There are some clients where we'd be fully invested, others where, we're about half invested, but that's based upon their risk tolerances and allocations.
All right, well, I was just trying to provoke you, actually. I mean, your principles are very similar to Warren Buffett. Let's talk a little bit about him. He's raised a lot of cash as well, and he's been pretty much right every time the market gets to a little bit too high of a valuation relative to overall GDP. He has certain metrics in terms of earnings. And so things do seem toppy right now. So if you don't mind, let's talk about both cases. Build me a bear case for the market right now, and build me a bull case. What would people that are bears be missing with their pessimism?
Well, I think the bull case would be, I think that the changes in the U.S. Trump is able to cut the budget deficit. He's able to pound more money back into the private sector. You're able to get capital invested, so you actually can spur on economic growth. And other countries around the world are a little bit less intrusive in terms of the economies. So I think the bull case would be, AI development drives productivity. We get a little bit better control again on government spending, and we get a lot more money invested around the world. That I think could spur things on. But even as I'm saying that to you, Anthony, I'm thinking to myself, that's a long shot right now because we're so stretched. I think the bear case is that we've got massive debt. I mean, I've been in the market for 35 years, and the debt to GDP ratio globally is, it's 350% debt to GDP. It was about 175 when I got invested, years ago. And when you look at the budget deficits, I mean, look at the U.S., which is the most important economy in the world. The budget deficit's like 6-7% of GDP. The overall debt is 36 trillion and counting. So the whole situation is not sustainable. So something has to happen. And I think that's what a lot of people are looking at now. What will the U.S. do? What will tariffs do? Will you be able to reposition some of the money to be able to cover the massive deficits? Can you cut the government back in size? These are wide open issues, and it's not going to be easy. And I think that's going to cause some uncertainty in the marketplace. And so I think that, we haven't had a downdraft in the market for a couple of years. We've had back-to-back 25% gains. And to think that we can't have a 20 to 30 or 40% drop in the market, I think is naive. Now, I'm not just calling for that, but I'm just saying that you want to at least be positioned in companies that can weather that and have a little powder dry. So I'm a long-term investor. I try to be an optimistic person. You don't make money by being a total pessimist unless you're a good short seller. But I do think that the debt situation and just the whole trade situation around the world is going to take some pain. We have to have some pain at some point. We've had a party for much too long.
And just let's add two more sentences to that about interest rates. So interest rates have been, let's say, sticky upwards. The Fed lowered rates a few times last year, but the indication is that they really can't lower rates right now. The inflation numbers are hot. Do I have that wrong, sir? Or do you think the Fed is in a little bit of trouble here, a little bit of a tight box on inflation?
Yeah, I think the Fed's between a rock and a hard place. I do think that it's going to be difficult to pull the rates down. I think the other issue, as you know, is that you've got this massive refunding of debt. I mean, was it 10 trillion this year? The U.S. has got to roll over. The next number of years, it's like 25 trillion. So you've got a lot of short-term debt. And I just don't think that the market's naive enough to say, we're going to buy all this debt at 3%. They want more. And so I do think that's a big issue, the refinancing. That's why when the Fed has been dropping rates over the last year, actually we've seen longer rates, middle to longer term rates actually go up. And I think that's because we are at a stretched point. And people aren't buying it. That just isn't going to be an easy thing to get out of. The Fed, if the Fed just walks in and starts buying treasuries again, then we're going to have a real inflation problem. There's just too much money in the system. So that's why I think we're at a point where we've taken this about as far as we can. Something has to break. I don't know what that's going to be. I don't know when it's going to happen. But as an investor, I want to make sure I'm in companies that won't be as vulnerable to that and have some flexibility in terms of our cash positions.
Okay, incredibly well said. I guess before I go to the audience questions, Jonathan, I want to talk about the Mag 7 for a second, because even though you're a value investor, I think you like some of them, like Amazon. So tell us a little bit about the Mag 7. Any concerns there in terms of their percentage of market capitalization of the overall S&P, et cetera? The concentration issue.
Yeah, there's no question that's going to be an issue, and I think people should be focused on it. The Mag 7, as you say, take up a massive amount of market cap, and they have been spurred on a little bit more recently by AI. We don't exactly know the benefits of AI. Yes, it's going to make some changes, but is it all being priced in? Is it too much being priced in? And so you do run those risks, the Microsofts of the world and Facebook or Meta and so forth. The one that we have kept reasonable position in is Amazon, and that's largely because of its massive retail business and its AWS. There's a lot of things going on in Amazon. We look at it as a price to sales. It's not outlandish. It's not outrageous. They do have a fair bit of pricing power. And so we look at that as a safer one, so that we can still sort of have some money in the game, so to speak. We did have a lot more in Apple, and that's become a much smaller percentage of our assets. We've sort of let that come down. They're having a tough time growing. It's a fantastic, amazing franchise, as you know, but growing off of their base is going to be difficult, and that's always the issue of the law of large numbers, as you know very well, that you just can't continue 20-25% growth type of thing. So yeah, so we're a little bit nervous about that Mag 7, and therefore our weighting in is quite low, and we're looking below the market now to find great companies that are trading at a fraction of the cash flow cash flow rates. Really, we really like free cash flow yields. That's what we focus a lot of our time on for most companies, unless they're in the mining industry. And of course, you're looking at net asset value and other valuation metrics.
Yeah, listen, it's just incredible the scale of these companies. I wrote an essay in 2010 when Apple got to $300 billion. I said, okay, well, how is it going to get to $500 billion? Just not going to happen. Of course, I got that incredibly wrong, but I hear you, and I agree with the sentiment. I just think it's harder today to justify a lot of these valuations. Let's go to some audience questions.
Sure.
What core investing principles from Buffett do you rely on? It looks like one of your fans, Suzanne from Canada.
Yeah, we have a lot of admiration for Buffett. When I got in the business, I'll just say something really quickly here, Anthony. Back in 1990, the fellow that brought me into the investment industry, Michael Lee Chin, he was a Buffett fan from the mid-'80s. And so we went down to the annual meeting. I've been to probably 18 of them over the years. And so have a lot of respect for Buffett. I think the principles are there is you try to look for businesses that have a moat. In other words, there's a protection around them. They have a consistent clientele. They have pricing power in their business. And then they're trading below what he would say intrinsic value. So you'd be able to buy them below a market valuation. Typically, we're looking at free cash flow. So we would do a discounted free cash flow model. But try to be very conservative on that. And buy them when other people don't like them. So that you try your best to when there's a cheery consensus, be careful what you're paying and try to pay as little as possible in those businesses. But I think the big issue is a moat, dependable business, great management also in the companies.
Well, it's the 30th anniversary of Roger Lowenstein's book, The Making of the American Capitalist. And so I reread that this past week, and I would implore people, if they like Warren Buffett, to read it. And oh, by the way, Jonathan, he was about 62 years old, which is roughly your and my age, when that book was written. And just to remind everybody, Warren Buffett made the monumental amount of his capital after the age of 60. Go look at the computational math and the compound interest, and you'll see staying in the game for a very long time. Got to stay healthy, Jonathan. You got to stay in the game a long time, okay? Compounding comes at the end.
Yeah, that's
the big lesson from Buffett.
That's why we're down in the Cayman Islands, right?
Right, exactly. Got to stay healthy. Okay, let's take the next question. How do you find undervalued opportunities when growth stocks dominate the market? Another great question. This is Thomas from New York.
Yeah, it is a great question. I think there's a number of ways, but two primary ways. Number one would be searches, so that we would use databases and just go through searches and run, price to cash flow numbers, price to earnings, price to sales, a number of different metrics. And it's amazing what you will cull out of your search. The second way that we do it is we have a database of other value managers. And so we do watch what some of our competitors are doing. When I say competitors, I mean, it could be anywhere in the world. We're not really competing with them in a direct sense. And we watch what other people are doing that we respect. And I think those are the two primary ways that we would ferret out companies that are trading at reasonable valuations. So you try to identify people who share your values and are also looking for companies that are appropriately valued. Yeah.
Let's go to the next question. How do you view investing in emerging versus developed markets in today's environment? This is Richard from the UK.
Yeah, I mean that is an excellent question. Also, from our perch, and this isn't necessarily the right way. This is just the way we do it because we are based in Toronto, basically just outside of Toronto, and our field of sort of travel is North America with a little bit in Western Europe. We don't spend a lot of time looking at the emerging markets because we're not there. We can't look at the whites of the eyes of the people running the companies. And so we've restricted ourselves, for better or for worse, to stay to the markets where we understand the accounting, we understand we can talk in English and communicate with the companies, and so that's what we do. Now, that does not mean there aren't tremendous opportunities in the emerging markets. I do think that that has to be within your circle of competence, and you need to be close to those businesses, understand the cultures, understand those countries, the laws, or you can get your head handed to you. My view is the best investment is the one that you can find closest to you if you can understand it well and in detail. So that's the way we operate. I've learned that it looks greener in someone else's backyard, but unless you really know that backyard well, be very, very careful.
Well, it looks very green in this backyard. And you know why, Jonathan? It's not my backyard, okay? This is obviously a rental down here. Okay, let's go to the next question. What long-term strategies help investors stay disciplined through market volatility? This is Steven from California.
Yeah, again, a couple of things. Your mindset. You have to have a certain mental disposition if you're going to be a good long-term value investor. Buffett and Charlie Munger, his sidekick, often talked about this. That one of the strongest attributes you can have as an investor is your mental temperament, your ability to look beyond just the short-term noise. The second issue I would say is that you have to know your companies well. If you know your companies well and you understand how they're doing, and a downturn in the marketplace really isn't impacting their business other than the stock price. You have to separate the stock price from the underlying business. And if you can do that well, then you can really make a lot of money, because the stock market will discount great companies from time to time simply because the markets are manic depressive. And so if it gets really depressive, you can buy a great business at a great price. So those are the two things. I think, first of all, you really have to develop a strong mental temperament. And then second, know what you're buying and why you're buying it. If you have second doubts, get on the phone, get into the annual reports, bolster your knowledge, and make sure that you feel comfortable with the investment.
Before I go to the next question, I want you to make the case that Buffett makes for indexing. You're beating the market. Hopefully clients can find you. Tell us what your website is so clients can find you. But then talk about a little bit about why Buffett is telling people to index.
Yeah, well, our website, we work with Wealthion, so you can get access to that. It's one of the money managers, so it's just Rocklinc, ROCKLINC, so link with a C, link.com, so rocklinc.com. But I think the reason why Buffett tells people to index is because people over diversify. And so I think, the old Peter Lynch term to de-worsify. So if you're going to invest in 100 securities, 300 securities, 500 securities, and pay a active management fee for that, then I don't think there's any way you can outperform the index. And so unless you are, in my view, again, we're biased because I'm a value manager, so I'll say it right up front. I think unless you're running really focused portfolios and doing something that's quite unique and quite different than the market, and you can do that well, then paying a fee for somebody just to be quasi or just off the market or very close to the market never works. So I think that's why most money managers spread their money around too thin, and they have too many positions. And therefore, if you're going to charge a 1% or 2% fee on that and pay trailers to a financial advisor and so forth, then there's no way you're going to beat the market. So I think Buffett says, yeah, just buy the index. You'll do better because of that. The frictional costs are a lot lower.
Okay, let's go to the next question. It's a great answer. Let's go to the next question. Should alternative assets like commodities or cryptocurrencies play a significant role in retail investors' diversified portfolio? This is Daniel from Ohio.
Yes, I mean, even though we run focused portfolios, and that's generally 20, 25 stocks, we try to diversify across a number of different industry sectors. So in other words, we're not buying 20 stocks all in financials or in mining or something like that. We do try to make sure we're across 6 or 7 sectors, because I've just learned over my life in investing that it's nice to have exposure, and you never know exactly which one sector is going to do well, especially if you can find great companies. So yeah, no, commodities I think do play a significant role in someone's portfolio, and a lot of people do like the cryptocurrencies, and you just want to really know what you're doing there. And I have not. I know, Anthony, you're a very big supporter of some of the cryptocurrencies. We have a couple of clients that have some cryptocurrencies in their portfolios. I still like the gold, silver, precious metals, probably my age, and the harder assets. But I really love the idea of cryptocurrencies, and so I think if someone understands that area well and they build that into their portfolio, there's nothing wrong with that. Just be careful. Don't be greedy. Build asset allocation. Be careful how people get carried away, right? Next thing you know, they're mortgaging their house and they're buying Bitcoin. Please don't do that. Have a proper allocation. Know why you're buying it, and take some profits too from time to time if you can, if you do well.
I would add one thing to that, and no leverage, please. Don't put any leverage on these assets. It would be a nightmare. It's like what Buffett says about leverage. It's a spear coming out of your steering wheel, and you're driving in a sports car on an icy road at pitch black. You when you press the brake, that's that moment when you don't want the leverage on. It's really, really rough. All right, let's take another question. What was the best professional decision you made that shaped your investing success? Another great question. This is Mark from Texas.
Yeah, the best professional investing decision, I think, would be to emulate other successful investors. So when I got into the business, again, back in 1990, I got in with a gentleman, Mike Wealthion, who's a very successful investor. And he said, Jonathan, first of all, you have to have an investment philosophy. Like, know what your philosophy is. How are you going to invest so you don't get pulled in every direction? You must be consistent in your approach and discipline. And then identify some of the best investors who have done that. And so, we looked at, Peter Lynch and Mario Gabelli, and this is back in 1990, the Sequoia Fund, Bill Rowan, and then of course Warren Buffett. And so we really studied those individuals. And I think if you study people who have been very successful at something, you learn so much. Don't reinvent the wheel. Stand on the shoulders of other people. And I think that's the best advice. Remember, as investors, we're not running the company. We're just trying to find great jockeys and great horses that we can run with, and so that's I think one of the best advice I had. Again, really emulate, have good mentors, and follow them, and find the recipe and stick with it, and don't deviate from it.
I think it's such great advice, and it just also duration. Right, Jonathan? Duration. Stay in good companies. If you own a good company and they're going through a rough spot, sort of hang in there. Don't be a quick trigger on the sell. Look at what Microsoft did after languishing for 10 years. But man, if you just held it over a 20-year period of time, you did incredibly well. Let's go to the next question.
Yeah, what I'd say there, Anthony, also, just following up on that, when you buy and hold, if it's a good company and you know the company well, your after-tax returns skyrocket. The way you make money, if you look at the Fortune 500, people, the wealthiest 500 people in the world, they're all business owners. And the reason they've been able to do is they've been able to compound tax deferred. And so be very careful. If you can buy a company and stay with it for a long term and defer your taxes and then compound that deferral and then pay the taxes at the end, you are so much further ahead. It's unbelievable. So again, it's the mathematics work if you can find great companies and stay with them.
And things like Microsoft that pay a dividend, or companies like that, as they grow, if you're not selling, you're not paying your taxes, you're getting that dividend on the untaxed portion of your gains. And so it's another way to feather your nest. Okay, let's go to the next question. Which finance book had a major impact on your investing philosophy and should be read by aspiring investors? This is Kevin from Canada. I'm going to go with Making of the American Capitalist, but this question is really for you, but it's by Roger Lowenstein. It's about Warren Buffett. It's a brilliant book about how he thinks. What books do you like, Jonathan?
I agree. I agree. That's an excellent book, and I've read that book. The other book, a simple one to read, is One Up on Wall Street. You go back, that's Peter Lynch's book. It's a very simple book. It's easy to read by anybody. The other thing I would suggest is, if you have a little more time, read the compilation, the compendium of annual reports by Buffett. So you aren't looking at his financials; you're just looking at his reports, his letter to shareholders. Read that. The thing that astounded me when I read all of his reports, if you read them over a short period of time, year after year, you'll find that it's shocking, his consistency, his honesty when he makes mistakes. And when you can read someone's life, 30 years plus of his investor career, and you can read it in a month or so, and you can put them all back to back, it's astounding when you see how focused that man was, and how disciplined he was, and how honest. As I say, if he made a mistake, that's fine. He admitted it. Errors of commission and errors of omission, as he likes to say. And you learn so much from that. The other one, if you're really a glutton for punishment, you get Ben Graham's Value Investor, but the Intelligent Investor. But that's a heck of a volume.
And they just came out with a new edition of that and a new forward. And I don't know, maybe I've lost my attention span. That's a little bit too much of a book for me. I'm going to take. There are no more questions, so I'm going to take the last question, if you don't mind, Jonathan. And I want you to tell us a little bit about your registered investment advisor, how big it is, how many people are working for you, what types of clients do you like attracting to your firm?
Yes, yeah. So I was in the mutual fund business up until 2009. So we built the largest private mutual fund company in Canada that sold at the Manulife. And then I thought, I'm just going to set up a private office in 2010 called Rocklinc. And so we just been fooling around with that, basically building that until about 4 or 5 years ago. That's when I started to add some other guys. And so I have other CFAs working with me on the investment side. So there's 8 of us. We have about $500 million, private, just family money, friends, relatives. And now we're adding, more families as we do a bit more advertising, and we're really into the growing that business. So it's all based upon, again, as I've talked about, value investing, differentiated investing based on the times that we're in, not just throwing ETFs or index funds at people, but actually, running segregated accounts, high quality, where we can customize for people and meet their needs based upon their particular circumstances. We are registered across the country, so we're in all 10 provinces. Which Trump wants to make the 51st state. We'll see. And so we're having a lot of fun, but really energetic, smart. I'm the oldest guy in the company by far. Hardworking young guys that are they love the investment business. They love research. They love ferreting out ideas. I mean, you know what that's like in your business too, Anthony. And it's a lot of fun. So we're having, we love the challenge. We love the intellectual challenge also of it, and especially when you get into a market like this where you've got so many things going on in the geopolitical world. It keeps your attention focused and finding good opportunities for people. So it's a lot of fun. We're having a good time.
All right. Well, congratulations on your business. Of course, we're going to put up on the Wealthion Network your website, and appreciate you working with our team here at Wealthion to grow your business. So your business helps our business grow and vice versa. So I like that virtual and very positive flywheel. And if you notice, I didn't ask you any questions about the 51st state. So I want to make sure feedback in the channel. There's lots of diplomacy between the Americans and the Canadians on this podcast today. Thank you again so much for joining us.
Thank you very much, Anthony. All the best to you, and I appreciate the opportunity to discuss these things on Wealthion. Great channel.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to wealthion.com and sign up for a free, no obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.